welcome everybody once again to our Proflex Macro Discussions. Been great, I would say, last few weeks. We didn't talk last week because of 4th of July, but overall, I would say markets have been making new highs. All risk assets are up. So I hope that people are, enjoying this. We have been talking about this for some time of how markets can keep going up. I know that in our WhatsApp group, we have been talking about valuations and so on, but we have always highlighted the macro. And if you go back to our investor day event last time, we showed you the money supply growing, that is still growing. There is no change in the big picture level why risk assets can go and can have a lot more run remaining. So overall, I would say good results for people who are invested. We always believe in staying invested. Yes, valuation can be stretched. We definitely recommend hedging. And that's, I think, the best way to achieve results. But again, our goal today would be to again look at all those things. What are the factors which we have to watch? So let's get going. I will share the screen on the markets. So this is where the SPX is. So if you can see SPX, we have talked enough about this era. I think we are not going to repeat it. We were watching this previous all-time high. It used to be called all-time high. Now we call it previous all-time high. We broke out and we are sitting on this trend line, which is not very steep, to be frank, if you compare from April. So it's a very sustainable run right now. We have, if you remember, we had taken 200-day moving average support after breaking out. It is doing pretty well, I would say. Usually after you enter a new all-time high, it's very difficult to define technical indicators because there is no previous supply, there is no previous data on volumes. And so we can go into more of a individual stock level, which are the key components. So as we all know, NVIDIA has made a new high. It is now the most, highest market cap stock with crossing 4 trillion and whatnot. So I would say this is the leader, which again, the all-time high was more of around 150. We are almost 10% up from there. On the other hand, it's hitting the top of the channel. So it's getting a little bit more, I would say, toppy in the sense that it has hit its upward moving channel. So this is one signal which says, yes, probably it has run up too much. Now let's look at the other big player, which is Microsoft. Now I haven't drawn the channel, maybe we can do that. But basically, we are looking at, again, another huge move up, big all-time high. And we are looking at, let's draw a channel here of whether it is very similar to NVIDIA. I would say it's not very different. Usually, so this is where the correlation helps. If you see, both Microsoft and NVIDIA are market has identified them as AI leaders. And if you see, the charts are very similar. They have been breaking out all-time highs. They're sitting on their channel support. So this is where I think correlation works very well. You see that all stocks are working same way. Now, where does the correlation break is the third biggest market cap, which is Apple. Now, this is an interesting chart where basically it is nowhere close to its all-time high. It is still struggling. And the reason I'll know, right, is Apple is the biggest one watching tariffs. There is no resolution. China still has 55% tariffs as the last update from the US-China trade deal. And Apple is suffering purely because of that. So yes, they have been doing some things around, moving their supplies from China to India and whatnot. But again, nothing is resolved. So now there's an opportunity there because we all know that this tariff has to resolve one way or other. So probably there is an opportunity here. But let's get back to SPX. So what we are talking about is SPX is making new all-time high. We have NVIDIA, Microsoft, which have run up too much. We have Apple, which is way below its all-time highs. We have Meta probably stopping at previous all-time high. So we are seeing it's a stock picker market. It's unlike earlier part of the all-time high where everything was going up. Now we are seeing a lot more stock picking based on the fundamentals, based on what's going on. So two possibilities can happen. As I said, technically, nothing is stopping it from going up. Technically, we are sitting on a very decent slope, which is not very, steep in general, if you see, versus the April stop. So we have gone into some corrections, milder corrections. So we can make a new high. Yields are in control. We were at the start of the call before we started recording, we were talking about the lot of concerns in the market in general with whether Trump will help push short-term rate cuts, what will happen to the yields. I think overall market is taking it very favorably. All the new inflation data, which is coming low. Everybody is kind of in a wait and watch mode, but the worst of the tariffs is behind us. Nobody is like the bond market at least is signaling they are not too worried about the issues. There will be some news-based reactions. Yes, we have gone up from 4.2 to 4.4, so let's watch it. And actually, we can even try to draw some trend lines to follow in future. So I would say we are still trending down, and we should look at, again, I always keep reminding 4.5% is when you start worrying, 4.7% is when you start getting, in a panic mode. So looking good, but I think the star of the discussion should be Bitcoin. We have been talking about it for a long time. We broke out above the previous all-time high, and we are right now in a discovery mode. We don't even know where's the next supply zone going to come from. And again, remember that we spent a lot of time here. We have formed an inverse head and shoulder pattern here, and look at this is a typical correction. In old days, a Bitcoin correction used to be 50, 60, 70%. Now we are seeing maybe a net correction of 30% or 35% or so, which is, I would say, has absorbed a lot of supply as it hit. And if you are in all access, we are already talking about, how we can see that there is a lot more bigger numbers which are possible. And again, why I'm reminding you, like, Bitcoin is not going to report any quarterly reports. Bitcoin is not going to come out with any kind of news. It's a pure supply and demand game, and that's why we keep asking about looking at the M2 money supply, right? Means this has been going up since early 2025 after some correction period in 2024. But if you look even longer term, we know this money has to be absorbed somewhere, and that is a macro which is very easy to follow. This is another reason why we have another commodity, gold, which we have been talking about. I think we have to now same results. I would say it consolidated, looking very similar to Bitcoin, but yes, it's still not broken out. Again, I would say it's still in a consolidation pattern. So we are seeing commodities doing good. We are seeing AI trade being back with Nvidia, Microsoft reaching new highs. We are seeing some concerns around trade deal with Apple still languishing. Tesla has its own story, which is like, it has all the Musk drama, which has all the robotaxi highs and lows. So there are stock specific stories in the market today to play around. There are stocks like Amazon and Google, which are middle of, recovering from their lows and not yet reaching highs. So we have a lot of juice left where all these stocks in this earning cycle. So what do we have to watch out for? We talked about macro. We have to keep looking at the yields, keep looking at how the bond market is seeing the near future. Then the big news in July, in 2 weeks from now, we will be talking about, in fact, 1.5 weeks from now, 10 days from now, all the tech earnings will start hitting. And that is when I think we will see whether we have more juice left, means how good the earnings can be. Last time when we talked about potential tailwinds in the earnings, like dollar devaluation is a big tailwind for tech stocks. In general, when we are seeing this money supply, when we are seeing buoyant economy, we can see a lot more of earnings can be even improving further. So there is nothing stopping Mag 7 from giving us a new high. Not every stock is an all-time high. So that's a view I have. And yeah, it's a fun times, I would say, because macro has gone through a good flush. It means the markets have seen corrections, so it's not a very over-leveraged market. Nothing new. We did talk about this last two calls in this Friday call. So we have to just find out where this market tops out. No obvious risk signals other than tomorrow Trump can tweet that he's increasing the tariffs on China to 200% again. So all those things are still on the table, I would say. But like whether medium to long-term pictures points to bigger highs, there is no real risk seen right now in the market in any of the data points. And as I said, yes, there are some stocks which have run up more. If they correct and there is some rotation, that's very much on the table. So those are the kind of things which we will be watching out. So let me take a few questions before we move on to other topics. Please feel free to put it in the chat, or you can unmute yourself and ask the question here. All right. So if there are no other questions, like I'll wait for a few more seconds. But I think basically there were a few things which have been discussed in the WhatsApp group. I think also I wanted to share a few more interesting stuff which we are learning as Proflex, as we are implementing some of our managed portfolios, or we are also trying to improve on our newsletter in All Access. So if you're a subscriber or if you're part of that, you will see those things. So we did share performance. We have been sharing the performance of that. I want to talk a little bit about that because a lot of questions have been coming in the WhatsApp group. So one thing is that we are, first of all, newsletter, All Access, and all the other, like All Access includes your Discord membership and so on. We try to keep it educational. Our goal is where people are learning. There are two goals there. One is how to allocate portfolio. Like if you see, if you know that we are a heavy believer in options and we use a lot of options in our trading. But I think even without options, if you're a simple buy and hold investor, we have beaten our model portfolio, which is a purely stock portfolio, has beaten the S&P 500 last 3 years as an example. The reason being, we try to educate about how the macro can be used to build an allocation-based system. And I get a lot of questions about, whether your trades, alerts, means I would say we are not a trading system. Like we're not trying to tell you, go make a quick buck on a trade. Because if you see, the allocation is the real winner. Means are you able to use the big picture AI views? And I want to talk about that even if you're not a subscriber. I think where as a retail investor, people miss out is on the, how do you allocate? If you like, are you allocating into the AI trend properly? Are you allocating the right percentage levels? Are you trading, let's say you believe that some random stock will go down. Are you even paying attention of how much risk you are taking? Like when you short a stock or when you go long on a stock, what is the risk reward? That's the part which we try to cover in All Access heavily. We talk about allocation level all the time, and talking to more and more people as we are launching these managed portfolios, and as we are taking more and more fiduciary responsibility with individual investors, we are learning their experiences. And what I'm learning is the biggest, for me, the biggest learning is that people fail at allocation level. You're looking at trade level. You look at, I made a quick buck on Nvidia, I could made a quick buck on Tesla. But have you ever analyzed whether at a portfolio level, how much over the year you made? And this is where the big difference comes in when you talk about 10-year returns, when you look at your compounding effect. That is where it makes all the difference. So I would love people to, maybe we should put up more workshops in this area. I would love to get feedback from people on how you think about it. But I wanted to personally share this because we just did finish our, we have done 50% of the quarterly reviews with the managed portfolio clients. And that is the biggest surprise for them. Like when they see, means we are not doing any magic. We are not finding some stocks which you have not seen. Everybody trades the same Nvidias, Teslas, and Bitcoin of the world. And when we are able to generate returns, I think what they are learning is the difference is with thinking portfolio level, thinking allocation level, thinking risk and hedging. And these are not magic trades. These are not something which we know more than anybody else. It's about a process, and that's what I want to focus more and more in our WhatsApp group, in our calls. So would love to have those discussions. So feel free to bring those questions. So I see some question in the chat. Let me take those now. What's your take on leverage ETFs versus options? I think it's a good question. So let me tell you, leverage ETFs, what are they? They are basically predefined leverages. And usually most of them are daily tracker. Like they are basically not taking overnight risks. They are saying that what is the daily move of the stock they're trying to track. And the problem is that, let me give you a very basic math, right? If a stock falls 10%, and let's say the 2x ETF is tracking it and it falls 20%. Now you got to $100 stock became 80. Now let's say the stock goes up 10%, you will have a 2x performance. You are going to get, maybe it will need to go 22% or something. You will not be able to capture because then you will lose a lot of this in the daily performance does not reflect. In long term, you keep losing money. And plus, these are very high cost products. That is one problem. But the second problem is that you cannot control your leverage. In options, I would not compare them because options is a very customizable product. You can build your own leverage. And most importantly, you can hedge yourself. Like a leverage ETF without using options, you're basically still hoping. It's just you're leveraging yourself. You are riding the same direction as stock, but there is no hedging. In options, you can build a scenario where you are, we have done workshops where we talk about how you can reduce your break even, how you can cover your potential losses if stock goes down. Those things don't exist in a leverage product. You are tied to a very specific day-to-day return thing. So I would say these are different purpose. They are good for short-term leverage creation in your portfolio. In long run, all of them have high cost and high rollover costs and high day-to-day fees and so on, which make you, like any leverage ETF usually loses money if you hold it for multiple years. So it's not an investment product, it's more of a trading product. We believe options can be an investment product if you allocate properly. So yes, that is, we have a different philosophy towards options because that is how we mostly trade in, for example, in managed portfolios, or we try to educate people in our all access product, because options can give you first of all, customizable leverage. And when I say leverage, it's not necessarily only for accelerating return, but also for hedging, right? Or for even reducing your risk because you are using an option versus a stock. Sometimes the risk is lower because option have two components. One is the intrinsic value and one is extrinsic. So extrinsic value is more time-based and intrinsic value is more stock price-based. So time is in your control. If you have a view of 2 years or 1 year, you can control that. In a leverage product, you cannot control that because in leverage product, it's only daily. You get only daily move and leverage around that daily move. You cannot say, I don't care about daily move and I want to do a month-based view, which is available in option, or a 6-month view or a 1-year view, which is available in options, which is not available in leverage ETFs. So that would be my answer. So I don't think they're anywhere close to each other. They are very different products and they serve a different purpose. But a good question. I think as we use options a lot all the time and we are a big advocate of them, it's a matter of learning the purpose of each of these things. Like it's very difficult with the mainstream media narrative of options are for gambling. Unfortunately, that has spoiled the real purpose of the option for most of the people. People look at quick buck rather than building a strategy around options. So I think that's one thing which we would love to. I think we had a great 2 workshops which we did, and we have this advanced group also now, WhatsApp group. I would like people to continue discussing these things, and happy to help further in creating more awareness. All right, so I think there was a lot more questions around Bitcoin earlier. We did discuss a little bit. Would love to figure out what people's view are, like where they are in the whole game. I think before the call started, without naming names, but I would say the question was, will there be a dip to buy again? This is unfortunate kind of questions, to be frank, for me, while we have been talking about this here. So I would say what we are seeing now is like, as I said during the market review also, that these are the asset classes which are now gaining, Bitcoin can go a lot higher or it can correct because it's a volatile product. So what I want to understand is, what stops you from allocating for longer term? Because I know that now there is no, even the problem around, people did not understand it enough. There was no validity. Now we are talking about last 1 year or so in these calls, or in many other forums we have been talking about. I actually feel like, it's unfortunate that people are still questioning whether you should allocate. Yes, the allocation level can be different for each of the people. You can start with as simple as 1 or 2% of your portfolio, but idea is that you should not miss. Trading is one thing, but allocations matter. So I think that was one of the topics I wanted to talk about, and which is very relevant from a Bitcoin world also, because you see that you can not always catch all the trades. You have to allocate for a longer term. That's same thing which I think a lot of people have. It's not different from what happened with Nvidia or what happened with other stocks, right? If you are just trying to trade and make a 10% quick buck, you will miss out the 5x or 6x or 10x moves. So that is, I think, where these questions come in, where I feel like we have missed out on learning about allocation, and that's why I'm harping on it again and again. So I think there's another question here which says, how do we know the start of FOMO for Bitcoin? Will there be any signs? I would say, in a way, means it's always been in FOMO. Like if you, this is the problem of modern day information sharing. Like if you go to believers, it has always been in a FOMO mode that any price you buy is cheap. And there's a reason for it, right? Means Bitcoin is basically as I just said, right, there's no quarterly results, nothing. It's a pure commodity. Either you believe in it or you don't. And once you believe in it, you basically it's a fixed supply, and it goes based on market. You can call it as a money supply. You can be a one parameter, or a institutional adoption is a parameter. Means if you remember, we talked about the whole FOMO from corporate treasury perspective 6 months ago. Yeah, the price reflection happens later, but the FOMO started at that time. FOMO was from corporate treasuries, from ETF. You can basically track it right now. The tools are live. You can every day you can check the Bitcoin ETF inflows. That in net inflow means that much new Bitcoin has to be bought and kept into cold wallets by BlackRock and Fidelity of the world. You can track every corporate entity which is registered. They're declaring on a weekly basis how much Bitcoin they're buying. So all this data is pretty much in public domain. So I would say the FOMO signal is there for last 6 months. Unfortunately, we are used to looking at price for confirmation, and we wait for price to break out. So yes, it happened, but I would say the signals have been there. Signals have been there for more than 6 months. If you're in all access, we have been talking about even before the signal, came, we saw the signals, and we talked about this corporate treasury going to blow up 2025 and 2024. We were talking about it since 2024. So I would say these are the kind of things which you have to see early. Means once the price moves and once you go to all-time highs, it's very difficult, right? Means you're always wondering when is the pullback, when can you scale up? But I think the best time is when price is still lagging the fundamentals. So, and I think the fundamentals were there, the FOMO fundamentals were there. I would say if you want to keep looking at it, just keep looking at ETF inflows, whether it's sustainable or not. Keep looking at announcements from different corporate treasuries. There are good websites now which talk about every weekly buys, so you can do those things. Let's take a couple of more questions here. Based on the recent Proflex insight, which mentioned that long-term yields are rising in spite of Fed rate cuts expected, what factors can now bring long-term yields down? Yeah, I think that was just I would say one of the things which we have been talking about. So there are two things at play right now. One is we have this Goldilocks scenario, right, where everything is going up, risk assets are going up, and so on. That is putting some pressure on the yields. So that is one reason. The second reason is Trump and the administration. They are there was hopes originally that they will do some spending cuts and so on. And with this big beautiful bill passing, we are now looking at more spending. So that is putting a negative pressure on bonds, and that's why the yields are going up. On the other hand, there's this whole treasury management which we have been highlighting for last 6 months. The SLR relaxation, which is helping the yields go down. So I think short-term rates are going down for two reasons. One is that people are getting hopeful that it's very close to end of Powell, and whoever comes in is guaranteed to accelerate the rate cuts. Secondly, even under Powell, we have two rate cuts priced in, and bond market is smart about pushing and making sure that happens. So that's why they are already going into and piling up into the 1 year and 2 year bonds or notes. So basically what is happening is we are seeing short-term yield going down. That has zero impact on long-term, because long-term is more of a 10-year view. They are looking at these policies and continuous spending, which people have lost hope now that there will ever be a deficit reduction and so on. On the other hand, they are not blowing away, because there has been management of buybacks and SLR relaxation. So we have a very good managed economy right now, where we are definitely looking at rate cuts in short term. And as the rate cuts come, people are also already pricing in some inflationary pressure in next 2 years. So that will again result into some pressure on long-term yields. So yes, that is something to watch. It's not an immediate concern, but I would say all factors with the risk asset being high, with the all these short-term rate cuts expected, and all this euphoria in next 6 to 12 months, maybe we'll reach many new highs, and bond yields will definitely start getting pressured, because whenever there is euphoria in stocks, bonds, first of all, money flows from bonds into equity when there is euphoria. Secondly, people get concerned about overheating. So all those things will definitely put pressure on long-term yields. And as we were discussing right at the start of this call, when we looked at charts, I don't think we are there yet, but we are highlighting what to watch, right? So long-term yields are definitely, rising yield is a sign which everybody has to watch. We keep reminding people. So while they're going up, I would say it's not a panic yet. So it's more about what can be a problem in medium to long run. All right, so we have another question here which says, can you identify trigger of recent rise this week for Bitcoin? I struggle to attribute to supply demand. So let me put it this way. Bitcoin supply demand is very well understood for two reasons. One is that there's a lot of on-chain data, and we have been talking about it, and we have been looking at reports. There have been some scientific studies done for how this supply gets consumed. But also, if you look at the charts, it's very, very simple process, right? When it's a fixed supply, you know exactly the issue rate from miners. So I don't think it's not definitely it's a supply demand. And technical breakouts happen when you basically run out. So one thing you can watch out if you really want to understand more about supply demand is something called, there are OTC desks. So most of these corporate treasuries, like if MicroStrategy or Bitcoin ETF market makers, they are usually not buying in Coinbase, right? They are not putting an order and hoping for best execution. They are basically making deals let's say, for example, today the ETF inflows came of $1 billion. They're not going to go to Coinbase and buy all of it. They will go to OTC desk and ask for what is available at what price and so on. So one track which people track, and a lot of industry reports come in on the OTC desk, how much of the supply is available. And that has been shrinking. So we did talk about it here that last 3 to 4 months, the price consolidation which was happening, it was absorbing a lot of supply. On the other hand, a lot of people were actually whining on the Twitter and everywhere in Bitcoin world that, oh, if billions of dollars of money is coming in, why Bitcoin is still stuck at 100K or 110K? So the answer at that time also was there is a huge buffer of OTC money supply. It's not on exchanges. Exchange supplies are very thin in Bitcoin world. Coinbase of the world and Binance of the world contains 1/3 of the liquid supply, 2/3 is in OTC world. And the reason being, unfortunately, Bitcoin started as a very concentrated product, even though we call it as a best distribution because the Bitcoin has been the longest blockchain asset. But remember that people, if you look at the wallets and so on, people who mined in 2012, 2013, they were mining in thousands or tens of thousands. Those wallets still contain tens of thousands of BTC. And we did talk a little bit about it 2 weeks back, I think, in the call, that those wallets have been moving recently. And there is a lot of new supply which came in through those wallets. So it's a normal process. If you are long enough in Bitcoin world, you understand. This is why these 4-year cycles are there, these consolidation periods happen. There's a whole demand and supply dynamics, and there are papers written, technical papers written on it, which we have shared previously in the WhatsApp group. I would say it's mostly around that. But second part is, as we see more and more, I would say, confidence in the risk assets, the inflows definitely make a difference, because now that ETF is a big portion, we are seeing huge implication of equity inflows and the allocations coming in. Bitcoin, with BlackRock's and Fidelity of the world are still pushing for higher and higher allocations in the high net worth individuals. So, and breakouts happen just because of some big money came in and OTC desk did not have the enough supply. And second thing is, there's a huge futures market. There's a huge derivative market which accentuate these like breakouts. These are purely technical breakout where we say that all the supply ran out, and then we suddenly have shorts getting killed. This is same. Like, I don't think we have to argue about the technical breakouts and how they work, but basically that is what is happening. I don't think you will see demand supply playing out on a day-to-day basis. Demand supply always plays out in 6 to 12 months basis, because of the buffers built in the system, and markets are very efficient. There are OTC desks, there are exchanges, there are arbitragers. There are so many middlemen in the mix that the demand supply balances don't move on a daily basis. So I think let's look at other thing, which is the other question is, what that means is, will TLT go down? I think TLT is more of a 20-year. It's even different dynamics, to be frank. Yes, I think if the long-term yields drop, the TLT can go down. But on the other hand, remember, TLT is not a zero interest rate product. It's most of the bonds which they have. So this is where I think a little more nuanced knowledge is needed for these bond ETFs. So 20-year bonds usually are not zero coupon, and the price can only go down to a certain level because they are paying a yearly or basically a monthly dividend and that dividend is coming from the coupon payment, which is coming to these bonds. So there's a limit to what the price sensitivity below, below a certain level reduces. So I would say it's a much more nuanced topic to discuss here in this call, but I would say yes, TLT will be under pressure if the 20-year yields continue going up. The second thing is, yeah, it becomes a great deal at some point because its yield is even the dividend yield of TLT uh, at certain point start beating your money market fund returns. So one thing is your price sensitivity or interest rate sensitivity because of the long-term rates, and the other thing is the coupon, which is not risky. Like 20-year risk is priced in. That's why the bond prices go down. But because you're getting paid monthly, most of the yield, then at some point it becomes a deal. So I don't think it's straightforward answer. So we can discuss more about it offline. So, but it's a good question. I think this is where the nuance of knowing your product is important. Yes, there is a inverse correlation of a bond price and yield, but the coupon rate means I would let people worry about it and read it offline, but do learn about the coupon rate and the yield of the bond, which is the actual paid out on a regular basis. That reduces the risk and it puts a bottom on the prices of those bonds. All right, so this is I think, good discussion, and I think it was a good question. But I think overall, uh, I I can completely understand a lot of people have been concerned. So one more thing which commonly came to me, and I'm just going to take up as a FAQ. A lot of people are concerned that, oh, we are sitting on a all-time high, or we are at a very high levels, valuations are high, and we have had discussion multiple times. I keep repeating the same thing, right? Means yes, it is something you have to be cautious about. We have been recommending hedging or reducing allocations in heated stocks. If you're members on All Access, we have already been talking about it. We are, if you look at our managed portfolios, those people are already seeing how we are completely hedging our portfolios. But I think it doesn't mean that you cannot, while you're hedging, you can always ride the upside. And I think that is one thing we should discuss, because if we always worry about markets going down after hitting all-time high, we will never be sitting on a consistent long-term returns, right? When we talk about S&P 500 or all these stocks making 10, 20% annualized returns for a long period of time, that means we have to keep making all-time highs all the time. So don't be scared of numbers. Don't feel like because we are at all-time high, it's more risky. There was one data point I was reading that every time S&P 500 has broken to a new all-time high from previous all-time high, usually 1 year later, on an average, we have seen 30-40% higher returns, like basically a huge run up after breaking all-time highs. So the probability based on history, if you take, I'm not suggesting it's going to happen this time, but I'm saying is this fallacy of this assumption that because we are at high, we have higher chance of going down. Historically, it has been reverse. Means once you break all-time high, there's a higher chance of you making much, much higher high 1 year later. So, and that is usually because, the dollar is getting devalued, and risk assets are just repricing that reality of higher money supply. And the same, I would say this is one interesting discussion we were having in the macro group also, that world is becoming short. Like, everybody can invest in NVIDIA. Yesterday, I was seeing the headline of Economic Times in India, which is like, Indian markets. They're talking about big headline was NVIDIA hit 4 trillion. Is it still worth investing? Means basically, even somebody in India is investing into NVIDIA. Even Economic Times thinks that, we have to give up data on whether it's worth investing into NVIDIA at this price. Means how does it matter? Because in the modern world, these instruments are available where people are investing worldwide into US stocks. NVIDIA is the favorite stock of everybody in the world, not just US. Bitcoin is anyway a global product. All these, the Mag 7 are popular names in every house, and whether people speak English or not. So what you don't realize is that concentration of capital in a few stocks is much more extreme in modern world. And secondly, these companies themselves have the economies of monopolies. They are making so much money, so much cash. And we have talked multiple times about it, that these are the companies who don't even care that interest rates are high, because they're not, the mid cap and the small cap, they rely on borrowed money. These people are actually minting cash every month and putting into treasury and earning those risk-free rates. They are on the other side of the curve. They are actually enjoying not only making money, nobody can compete with them because a new player has to rely on borrowed money, on a VC money, or basically somebody investing, and they have to climb a higher bar to even compete with these older players. So it's not unreal that these companies will become stronger and stronger in the high rate environment, and they will be even more valuable in next 5 years if the rates don't come down. So this is how I think the macro impacts us in the modern world. Historically, the top players used to be, chevrons of the world, and they did not have this cash pile. They had to still get the oil out of the ground, or they had to sell more oil, which cannot scale up the same way a Google or a Apple or a Microsoft can scale up. So when people look at historical valuation, they forget that the world is different. The world is now driven by software. Your S&P 500 is built off purely software companies as a market cap, or even if not software like Nvidia or Apple, they are kind of monopolies which are growing like crazy. There is no lack of demand for Nvidia or Apple. So all these things are very different from historical stocks and S&P 500. Unfortunately, finance world, everybody is used to looking at historical data valuations, but world keep changing. So we have to be aware of that when we talk about valuations. And this was a discussion, I think, last couple of days in WhatsApp group also. I just wanted to, maybe we can use this if somebody has a comment on it, because my view is history only helps you serve to learn from it, but it doesn't repeat exactly same. And secondly, the comparison is not fair when we look at old world economy and new. Okay, there's another question. Let's take it. I think we will try to wrap up after this. If you think of reverse stress testing, what would cause markets to decline, if at all? I think markets can decline for any reason. As I said, markets are always, in modern world, we have a lot of leverage in the system. In modern world, there are a lot of, just like we talked about, there are a lot of middlemen everywhere. There are a lot of like complicated products, and there's a lot of leverage. Like we have seen last year, the yen carry trade on August, July, August timeframe, a simple, hedge funds blowing up can create a huge black swan event for a short term. So declines can happen. I think what happened in April, just people panicked. They started reversing. Hedge funds started exiting because of the tariff news. And then it was a kind of a very fast 20-25% drops into really, really solid companies. Like, why would Nvidia be trading at $85? Means nothing changed for Nvidia. In fact, Nvidia was already down because of DeepSeek. Just because the reason why the stocks can go up very fast, because everybody's investing in the same stocks. There's a huge leverage products available. So that's why they keep going up. Similar way, the drawdowns happen because there's too much leverage, and same way the news travels faster these days. If a drop happens, people are also getting liquidated and so on. So I would say decline can happen because, again, we can just have a correction because some negative news came, just like even before the whole tariff war. The DeepSeek was one example. One news making a huge impact into NVIDIA, AMD kind of stocks, and suddenly there are cascading liquidations. But are they sustainable? You see, every time that happened, because there was no fundamental issue in the market, the macro was solid, most of these things reversed. So what I can say is, if we forget the noise around, oh, this stock dropped 20%, 25%, we can keep watching what's happening with the yields. I would say, I always believe in bond markets being real money, and stock market is paper money. And bond markets will give us the concerns. If the macro concerns start developing, we will see the yields going up, long-term yields going up, and we can take that signal. If anything else, I would say the money supply starts going down. If the policy changes, which is unlikely, I think there is no appetite in any political party to reduce spending or to reduce deficit, as we have seen again. So I would say that points to a long-term high market always, because it's not about markets going up. We are thinking wrongly. It's about we are devaluing the currency. And this is why Bitcoin is going up. This is why gold is going up, because they are not related in the same manner. Like stock prices can go up. Everything going up means the dollar is coming down, because we are just creating more dollars. So this is why we say that macro is all about money supply. So if you're asking me what could cause decline, I don't see macro being the decline. But yes, the yields going up can start. That means bond market is the real money, can impact the paper money at some point. So we have to watch that. And yeah, policies can change. Like if the tariffs are back on the table, which can cause the whole uncertainty again, short-term declines can happen. So a lot of factors can result into short-term declines, but medium to long-term, why means I would love to debate on why would it go down when money supply is going up. Means all risk assets have to go up, and if you have to allocate money somewhere, and if everybody believes that AI is the next trend, super trend, then why would Nvidia not go up and Microsoft not go up forever? But if, let's say, you tell me tomorrow that AI was all fake, and suddenly somebody big comes and says, you know what, AI has no value, we are stopping all the investments, that will be another reason will our market will go down, where we will say that suddenly Microsoft and Google and Meta are not buying the servers anymore, Nvidia crashes by 20-30%, and that can trigger a big drop again. So why market could close, I can give you 10 reasons, but whether they will happen right now, nobody knows. And there's no reason today to believe that market will go down, because we don't know. It means when there is no trigger right now, and that's why we have to keep watching and we have to keep analyzing. But at a macro level, means if Nvidia drops, doesn't matter, something else will go up, and that's how we have to always focus on. When the money supply is going up, the S&P 500 can go up much higher. Yeah, go ahead, please.
What is your take on the Bitcoin treasury companies? The prevailing view is that it's a mandate arbitrage for institutional investors, but there's also people taking advantage of that to pump up their stock and buy Bitcoin. But aren't those like weak hands? Like they're gonna sell, like they're gonna buy up. Some of them are gonna buy up Bitcoin, and if the price drops by 10%, doesn't that create a lot of extra? I mean, I know this is a more of a short-term thing, but this is a pattern, right? But what is your view on them on different levels?
No, I think we have covered a little bit in a few calls last. Bitcoin Treasury is a concept which is newly, I would say, popularized by MicroStrategy. So it was difficult for market to understand. And now I think we are seeing a copycat culture, if you're referring to that. Like a lot of new companies are doing that now. I would say it's in our early days because there are two reasons, right? One is that Bitcoin is already going up. So first of all, there is zero pressure on these companies, because think of it as a debt to equity ratio. Like basically, what is their real asset? Their asset is Bitcoin. If Bitcoin is rising in price, whatever they purchased at previously, their asset is growing. So they have more ability to take debt. Secondly, the appetite for the debt world is very high because there is trillions of dollars of market, and they are senior to the stock market. Like their position in the company cap table is senior to equity. So if your stock price can drop if the Bitcoin starts correcting, or if they do irresponsible lending, for borrowing side. So for example, if their ratio of their debt becomes too high versus what the assets they own, and market starts questioning their viability. When you said they may dump, they don't need to sell Bitcoin till the debt is called for. So I would say it's not a bubble yet. It can form a bubble, yes, but I think it's a very smart product. It was difficult for people to understand. I think we were very early when we were. To be frank, I have not even talked about MicroStrategy or something to a lot of our clients, because we knew that it's difficult to understand. But we have been talking about it, why these are great products. But remember, we are still having this conversation when 80% of the people in the world still don't believe in Bitcoin. They are not investing in Bitcoin. Now you're talking about Bitcoin as a asset to borrow more and buy more Bitcoin. So definitely it was crazy to think about that. But to answer your question, yes, they are. Right now, a copycat culture is evolving. I still think none of these companies are over leveraged. Most of them are actually sitting on gains on Bitcoin. And at some point, I would say the trigger will be when, first of all, Bitcoin has to reverse. That puts pressure on their assets. If Bitcoin is going up, they're basically becoming more and more solid every day. And that is the thesis. That's what the whole Ponzi relies on, right? In true world, means if you don't believe in Bitcoin, it's a pure Ponzi. Because you are basically buying the asset and then you're using the same asset to pump not only the asset price, because you are the buyer, and you are using that increased price to take bigger loan, and then you're buying more. So this is means if Bitcoin is real, if there is always demand from somewhere, you would probably see this Ponzi never breaking. For that, Bitcoin prices to keep going up. But as we all know, there is always a seller at some price. So maybe at some point, Bitcoin will have a lot of sellers, price stop going up. Some of these treasury companies will be over leveraged because they got too greedy, and they will fold up. So my opinion is it's a pretty good trend for Bitcoin. Is it responsible? Probably not. Is it anywhere risky right now? I don't think so, because most of them are pretty healthy debt to asset ratio, and they are not anywhere risky the way people are projecting them to be. Uh, can they become risky? Yes. As if Bitcoin drops by 40-50%, many of them will come under stress. So you have to evaluate on a case-to-case basis. I won't say every corporate treasury is a good investment, but these are great products if you believe in Bitcoin. But by the way, one more thing is you're paying premium to buy them. So I'm not suggesting that they are good investments. I'm saying they're viable businesses. Um, for buying and holding, they're not, probably, because why to pay 2x or 3x premium on Bitcoin to buy these stocks? Because you have to first recover that after you buy it. So unless you have a plan for them in terms of either hedging them or something, they are not really great value investments, but they are viable businesses.
But in the case that Bitcoin drops 40%, then they would then be forced to sell. They may be forced to sell, so that could prompt another drop by another
Mhm.
20-30%, right? Because of
So
their selling.
none of the big treasury players who can impact the Bitcoin market are anywhere close to that level, where they right now, based on my last analysis, on an average, corporate treasury companies will be under pressure to sell only when Bitcoin drops by 80%, not 40%.
Oh, wow.
So so their debt to asset ratio is pretty healthy, as I said. So there is no real risk there. And this is where I think people are not realizing the corporate treasury effect on Bitcoin. Uh, when you have BlackRock every day presenting to investors worldwide to keep increasing their allocation, these are not corporate treasury. These are individual, high net worth individuals, big family offices, big, uh, even sovereign funds like Abu Dhabi's of the world, and all these people. They are buying Bitcoin right now, and that tailwind since last year when the ETF were approved is being used by these treasury companies, that there is no risk of Bitcoin falling by 60-80%. And they are threading the needle by keeping their debt to asset ratio around that level, where they are not at risk till 60-70% drop happens. So they have a long runway. So this is why I'm saying, like, you need to go into the next level details. Unfortunately, we see a lot of armchair analysts who are looking at the process. Yes, it's a Ponzi. Yes, it is traditional finance would call it as a very irresponsible way of investing. But when you double click on them, they're all doing a very responsible approach as of now. Means, can it change? Yes, it can change. In like 6 months from now, Bitcoin is at 200. They keep buying at that price. Their average price goes up to 150K. And let's say their average buy price is 150K, and then Bitcoin crashes to 120K. Suddenly their debt to asset ratio doesn't look good, because today it's good, but once you're making losses on them, you never know, because you priced for 500K, you did not price for 150K. So a lot of things can happen in near time. We are not there yet. As I said, if you double click on this data, you will not see this particular corporate treasury side, because we are tracking very closely this particular trend, and we don't see any bubble in the system right now.
And what do you make of BlackRock stepping up its allocation to Ethereum, and then Fidelity came out with the report, the Fidelity Institutional came out with the report about blockchains as emerging economies, and how Ethereum, like this whole Ethereum narrative seems to be reviving by Fidelity and BlackRock.
I think so. I think Ethereum is definitely gaining ground in last 6 months or so, since Trump administration came in, not because of Ethereum itself, but because there is a lot of stablecoin success, which is most of the stablecoin market right now is on Ethereum. And a lot of real estate is coming on chain on Ethereum. My only challenge with Ethereum is that Ethereum does not have a solid economy in terms of store of value, because they have been inflating. They have centralized teams which decide the distribution and so on. But again, I don't want to go into all that. But overall, then there are competing chains, right, which are even more efficient. Ethereum cannot scale. We all know it for last 10 years. That there are a lot of other issues, and you have Solanas of the world, and you have so many other competitive products. So Why would it be store of value? I don't know. BlackRock can pump it because I think all of these people are, they have vested interests because they have, pretty much all the ETFs they are launching. So I'm sure they will talk about allocations, but if you talk about the digital gold narrative of Bitcoin versus a platform narrative of Ethereum, they are not comparable. So I would not say put them on the same level. I would say Ethereum has 10 different risk factors. Bitcoin has very different risk factors. So none of them are comparable. So I don't know if I answered your question, but yes, that basic idea is that we believe that at Proflex, I think we used to do a lot of crypto. We believe that Bitcoin will outperform most of the assets because of the adoption and digital gold narrative. Versus, yes, you can get leverage. You may get a big run on Ethereum once in a while, but I don't think it will compete in a store of value.
Maybe not as a store of value, but just as a allocation. And if someone's balance sheet is 100% and they're putting 5% in Bitcoin, obviously it varies by case basis. Like, should they be putting one additional 100 basis points in Ethereum? Not because it's a store of value, but because it's
Yep.
it's effectively a layer one. I mean, like,
I understand. So what you're saying, so means again, it goes back to your belief in this. It's becomes more of a tech investment, and if it is a tech investment, it's on par with the means of whether they can be disrupted. Then it's a discussion similar to Nvidia's and Apple of the world, right? So I would say think like stocks for Ethereum. Uh, it's not going to fall in the Bitcoin basket from analysis perspective. So yes, Ethereum has potential. Ethereum has not done well at all, which we had, at Proflex, I think we had exited Ethereum long time back, like 2.5 years back. Since then, Bitcoin has outperformed it by like 4 to 5x. And we believe that there is no real solid reasoning for Ethereum to succeed because of the competition, and also because of the bad history and scalability and a lot of other reasons. But anyway, my goal is not to discuss Ethereum specifically, but what I would say is that Bitcoin and the rest of the blockchain token world are totally different asset classes. So as you said, it is more of your bet on Ethereum platform getting adopted, which is happening for sure. It's a big difference in last 6 months versus it was basically dying out under the previous administration. The current administration has opened the door for a lot more adoption of Ethereum use cases. So there is a potential, but there is going to be a lot of competition, and I think it's a totally different basket. It's a technology discussion rather than a crypto style or whatever, the old crypto style discussion about demand versus supply.
all right.
All right, guys, I think we are on the top of the hour. Great discussions again. So thanks a lot. And let's keep the questions coming. And it's a great community we are forming on WhatsApp. So do invite your friends if you want to grow this community. And let's talk more. As I said, my goal now going forward will be to discuss more about allocations and how people really think about investing, because I see that there's a gap here, which I'm observing with our clients and a lot of people when they ask questions. Would definitely love to get your feedback on those things. Because one thing which I have learned in this industry is that it's nothing. It's not about what you know is going to happen. It's not about finding a great stock tip. Outperformance is all about how do you manage a portfolio strategy, allocations, and how do you make plans where you first have to agree that you don't know what's going to happen. And that is the big difference I have seen, where people have where they have gone with their belief this is going to happen versus I don't know what is going to happen. That can make a huge difference into performance of your portfolio. So once you bring those scenarios in, I would love to have that question and maybe even a workshop there if this helps people, because that is where I think I see a big gap in most of the investors' understanding of how to beat the markets. So again, have a great weekend, and let's keep talking here. Thanks a lot for joining. Bye bye.